Alright folks, how's it going? So, what have we got this week? Here's my total return information. I was pretty much flat. Life Strategy 100 was a little bit above flat. Well, you can see the numbers there yourself, so I've underperformed everything but LS60. But it's all flat really, not much happening. And then a record of the dividends I received this week. And as you can see in the pictures, there's the proof in case you didn't believe me. Why wouldn't you believe me? And there's, oh God, I think I'm funny, don't I? I spent £8 in McDonald's that day, so I typed it in there. But yeah, £3.22 from McDonald's. I didn't pay them money. So yeah, total £344.90 for the week, which is nice to receive. And then just to clarify, you know, that doesn't change anything about my projected income for the year, which is still projected to be about 4.97% higher compared to the period last year. That's going up to the 6th of October, which is just the random date where I started unitising my portfolio. So everything goes to that date. And so that performance of 0. I'm doing things out of order again. So that performance of pretty much flat, this is where it all came from. You can, well, I'll do the same thing I did last week. I'll just show it all in full screen so you can see all the numbers at once. Anything to note here? I mean, it's pretty much a mixed bag, but nothing too big apart from GSK. I should probably look up what's happening with GSK, shouldn't I? Barclays up a bit. Schroeder Real Estate did quite well. In fact, it was up a bit. It was up a bit more than that at some point. I remember seeing it was up 22%, and I considered selling 400 quid's worth. But then, as soon as I tried to do that, the lack of liquidity in the share indicated to me that I wasn't going to get anywhere near a 22% profit on the money. So I was going to switch these two, but I decided not to bother in the end. You know, the lack of liquidity in those shares means that you've got to take these two prices here that are quoted with a pinch of salt, really. Anything else? Oh yeah, Harmony Energy seems to have done reasonably well. I'm not quite sure, to be honest. I mean, I'm only a couple of percent up on it, but it's done okay. Yeah, so I'm not really sure what happened with GSK. I'll just hold it forever and see what happens. Okay, back to my video notes. Oh yeah, the Hargreaves Lansdowne, right. I'll splice in the me checking how the LISA transfer was going throughout the week here. Alright, so it's 20 days after the transfer now, 16th Monday. So I just logged on to Hargreaves Lansdowne, and as we can see on the screen now, everything has disappeared. So that's a good sign, I guess. And there was a message here. Yeah, so there you go. It's they're just telling us that the money's been sent to AJ Bell and it might take a day or two. Yeah, I logged into Hargreaves Lansdowne because Montenero European Companies Trust, that dividend's due today. So I logged in to see if it was here. So I'm not sure whether it might have arrived in Hargreaves Lansdowne before they sent the money to AJ Bell. That'd be nice because it's quicker. But I don't know. That's probably optimistic, and it probably arrived after they sent the money. So I'm guessing at some point there'll be another transfer. But if we just see AJ Bell, we can see that the cash is still zero. To be expected. They've only just sent it. So. All right, so 2 days later, 18th, and we've got the first tranche of the cash, £137.41. So it seems like the dividend should arrive later at some point, not exactly sure when. And we're back. So yeah, as I've said, oh yeah, lament on not buying BATS. Yeah, I looked at this earlier this week. I was scrolling down here and I noticed that yield has gone. Oh, that's higher actually than it was before. When I was looking at this, it was about 7.8 or something maybe. So maybe my point has been reversed a little bit. But anyway, if we look back at this video, yeah, so as you can see here, I was here talking through the options of what to do with the money, and I was like, oh, I'll put £2,500 into British American Tobacco, BATS there. And the yield there shows as 8.14, but that was me being pessimistic. If we look at a different part of the screen, yeah, so this part of the screen here, you can see the yield on BATS was about 10%. And then later in the video, I'm like, right, well, I haven't got enough money in the ISA, so I'll have to delay that. And then the price went up of BAT, and I never ended up buying it in the end. And that was the date of my video. and I've lost. I could have made 22.5% on that so far. But actually, when I typed that into my notes for the video this week, was it the 8th? Was it the 16th? Yeah, I think it was probably about there. So it was actually a lot worse when I wrote that note to myself to talk about this in the video. I would have lost out on a 30% gain there before. So things go up and down, don't they? I'm not sure if it's gone ex-dividend or something, but yeah, bit of a missed opportunity there to get a 10% yielder that actually went up. So that's a bit disappointing, isn't it? But yeah, that happens all the time. But yeah, my reasoning was nothing to do with, it was all to do with the cash, not having enough cash in the ISA. And if I waited a little while, I could get it in the ISA rather than buying it outside of the ISA. But anyway, there we go. That's just me looking back and regretting my lack of action. The alternative was probably one of these. I think maybe it was Harmony Energy, maybe it was Next Energy Solar Fund. I can't remember what the direct alternative was that I went for in the end, because I just saw that the price had gone up a bit. It was probably somewhere around here, and I was like, oh no, it's gone now. I've missed my opportunity. But yeah, I mean, looking at that though, this could still be a half decent time to buy, couldn't it? Because it's now back up to 8%. Which is still quite good. Announcement. So this week, the only announcement we had was the City of London annual financial report. I don't spend too much time going through these in detail. I just kind of get the headlines, to be honest. That being that the total performance was 15.6%. I wish they'd say what that is though, because on first reading, is that the NAV performance or is that the share price performance? But yeah, if we scroll down a bit, we can see that it's the NAV performance, because the share price performance was lower at 11.3%, which makes sense because if we look at this chart, I think we're on the 3-year chart, yeah. We've gone from, is June somewhere around here, and then June is somewhere around here for 2024. You can see that the discount has gone from a positive 1.5%, 1.75% maybe, to a negative 4-ish%. So that makes complete sense that the share price total return is lower. I mean, to a certain extent, because I'm holding this for income and the growth in the income, it doesn't really make any difference to me because I just plan on holding it forever and and hence the NAV doing well is all that I need, because if the NAV does well, the dividends that I get paid from it over the decades ahead of me benefit from that. Doesn't matter what the share price does because I'm not going to sell any of the shares. And what else is of note worth mentioning? Oh yeah, the revenue per share was 20.9p. So that's the income that the underlying companies that they own pays them. And then the dividend that was paid was 20.6. So that gives us a dividend cover for the year of 1.45%. which is exactly how Hargreaves Lansdown have calculated it too. So it's good that it's covered, and it's so because it's covered, the revenue reserved per share also goes up a bit, which makes sense. 6,789. Why has it gone up by 0.5p though when the difference is only 0.3? That doesn't quite add up, does it? It's probably because it's probably something to do with share buybacks or issuing of shares, because obviously the revenue, the number of shares might have changed over the year. And so obviously what matters to me most is how the earnings or the earnings of the company are changing. And what we've got there is a 3.6% increase, which I could have calculated myself because it's just going from that number to that number, isn't it? 21. Let's just double check. 20.9 divided by 20.1, 3.98%. So again, that doesn't add up to me. Earnings per share increased by 3.6%. But the earnings per share went from 20.1 pence to 20.9 pence. And that's 3.98%. Yeah, I don't know what's going on there. Voiceover in the editing suite here. It's probably something to do with the share buybacks again. It's probably the change in the number of shares throughout the year means that there's different earning potential at different points in the year, so it complicates those numbers, doesn't make them consistent looking. So the bank shares was the most positive contributor, which I benefited from in my Barclays and NatWest holdings as well. Amounted to right. So the special dividends are down. In a way, that's kind of a good thing, because you can't rely on those. So the more of the income that's being generated from normal dividends, or like recurring ones, is a good signal for the future years, isn't it? So the ongoing charges of 0.37 is still pretty low. Yeah, I think it's either my lowest or my joint lowest. I think Scottish Mortgage is the only competitor on that front in terms of the low ongoing charge or ongoing costs, because it's not all charges, some of it is costs, as you can see there. That's good. So that number, if everything else stays the same, next year that number will go down to 0.345 instead of 0.37 next year, if everything else stays the same, because look at that reduction, it's always going down. Yeah, so there was 20 million worth of shares issued. Seems to have been the third quarter of 2023. And then it bought back a load of shares. So net, that's about 14 million bought back. Well, worth of shares. I'm not sure how many shares. So that might explain some of the inconsistencies in the numbers. Or they seem like inconsistencies, but they're not, because of the share buybacks and the issuing of shares. So there's an AGM on the 31st, which I normally listen to just for I watch the live stream of them normally, because the questions at the end, they get excluded from the catch-up watching. You can only watch them on catch-up if you like, but they don't show the questions at the end, which is normally the most interesting bit. So this is where the returns. So that's how much of the return in percentage points is from the issuing and buying back of shares. The arbitrage between the share price and the NAV per share. And gearing there, I always like to see the gearing doing us well. Seems like it made us a lot more the year before as well. But obviously some years that's going to be heavily negative when things go down. Okay, so I have read the whole thing pretty much just for my own interest, but there's nothing else in there that's worth mentioning in a video. What the eagle-eyed folks amongst you might have noticed this little part of my spreadsheet. It was something I was pondering, was a swapping of City of London, because if we add up all of the Janus Henderson run trusts in my portfolio, it adds up to 26%. And I was just thinking that's a bit high. So I was considering, for a lot of the time, this little calculation that's done here was negative, so there was no point in doing the swap. But JPMorgan Claverhouse, which is the one I'm talking about, JCH, is at a bit of a discount. So I was thinking about swapping City of London for Claverhouse, because as well as having a higher yield, I'll be swapping something that's at about par. There's no discount to NAV. For something that's at about 6% discount. All very similar portfolio there. They've got a bigger weighting to Shell and AstraZeneca, the biggest ones in the market. But, similar results, similar long dividend histories. In the end, though, I think I've decided that I don't want to do it, mainly because last year they had their dividend wasn't covered. They were 11% down, even though the year before that it was 4% up. The big reason for that, I think that year they had a big increase in the dividend. I don't see why they've done that if their underlying portfolio doesn't support it. Although actually, no, it might have been that one. I think they must have had lots of special dividends, because they had dividend cover and they had a massive increase. But then it seems like it's all come back again, and they don't have dividend cover anymore. So I just figured future years aren't going to grow as much as City of London, at least 1 or 2 years in the future, So I've decided, at least for now, who knows, if at some point this number here that I've kind of tried to estimate as being like the income differential if I swapped them, if at some point that number goes to like 60 quid and I end up with 45 quid extra, then I might think about doing that swap. But I think because of the lack of dividend cover on the Claverhouse trust, I think I'm not going to do it, at least at these levels. I'm going to stick with City of London. So yeah, we'll see how that goes. And I'm pretty sure part of that, which in fact might explain the lack of dividend cover, is that the loans they have are a lot shorter term than City of London. City of London have fantastic, very long term, low interest rate loans. So, and that could have contributed to their lack of cover in Claverhouse, and it also makes me more comfortable sticking with City of London. Oh yeah, the only other thing to mention is I'm still waiting for the MTE dividend, even now on Sunday. Sorry, no, it's Saturday today, isn't it? The 21st. Yeah, so I'm still waiting for that. So I'll keep you posted. All right, I'll see you next week then. Bye bye.